A sort of share price for the country. The rand has been taking strain in recent weeks. A slew of negative data and surveys have battered confidence in South Africa as an investment destination. It started with news that the country's economic growth had contracted by 0.6% in the first quarter. Since then, PMI data and business confidence, which are forward-looking gauges, have put in a dismal showing.
All of these have compacted and made the market really concerned about how South Africa is going to manage that current account deficit, specifically if we potentially have the risk of a downgrade on Friday. Because what that ultimately means is that the foreign investors or foreign flows that we see into South Africa could be under risk, and it becomes more expensive for South Africa to fund itself. So those types of concerns have been heightened, and the reflection of that has really been in the rand.
Given the ongoing labour unrest and negative economic data, the market is anxious about whether ratings agency Standard & Poor's and Fitch will downgrade South Africa's credit rating on Friday, making it more expensive for the country to borrow money for much-needed investment, which would ultimately propel growth. Sentiment is weak.
I think that there's definitely a heightened risk. We are on negative watch already. Unfortunately for us, we haven't managed to contain the current account deficit, which is one of the major factors, as well as the fact that South African growth remains relatively benign.
South African government bonds are part of the City World Government Bond Index, which foreign investors buy into because they're considered a safe bet. A ratings downgrade could well threaten SA government bonds' continued membership in the elite bond club. Nompumelelo Siziba, SABC News, Johannesburg.